Hey traders, this is Blake Morrow with Trader Summit, and with me today I have Mr. Michael Boutros. He is the senior technical strategist over at Forex.com. Good to see you, Michael. It's been a while. It's been a while.
Yeah, it's great to be here. It's been about a year. Good to see you again.
It has been about a year, and I was just looking back at the title of our last conversation, and you said I'm in the higher for longer camp. Well, I don't think you could be more right than that. So.
Here we are a year later, and even coming into the year with market participants saying somewhere 5 to 6 cuts, some crazy, crazy expectations, we still really stuck with that base case scenario just because of what we were seeing in the underlying data.
Yeah.
But it's interesting that here we are, and we're talking about the first cut still halfway through this year, a year later, a year and a half later after we spoke. So it's interesting to see how this is going to play out.
It is, and since we're coming right off the FOMC, and let's talk about the higher for longer. Here we are. You heard the Fed yesterday. You heard Fed Chair Powell. Overall, what are your thoughts? I mean, because we are getting into that. It becomes more of a timing issue based on having 3 more rate cuts at 6 meetings, and we're going into an election cycle.
Yeah.
Where do you stand? Because it's a tricky one,
So
right? It's
it
tricky.
is a very tricky one, and it's different whether you're asking what I think they should do or what they should be doing. Where I'm at is, we just saw them upgrade growth projections, upgrade or increase employment projections, and increase core PCE, but at the same time, we're talking about 3 cuts. So like the logic behind it is a little bit dodgy for me. It's either, we're going to tackle inflation, inflation's not there yet, we're going to stick it until inflation lands, or what is the cause? And I think a lot of guys in the presser did press him on that. And the only thing I continued to hear was, we're going to get 2% over time. We're going to get 2% over time. Okay, that's where my disconnect is. Why are we talking about interest rate cuts if we're looking at a strong, like you said, markets are all-time record highs, employment's there, inflation hasn't really tamed yet. So where's the disconnect there? That's my humble opinion of what's going on. On their front, I think they're playing it twofold, right? They're talking about the risks to long-term, what they call higher rates. Historically speaking, obviously, we know this is nowhere near higher rates longer term, but they're worried about the damage and the lasting effect that'll have to the economy, and they don't want it to break. Heading into an election season also, you're not going to come out and roil the markets and say we're not cuts. If it was up to me, again, if I was a central bank, I don't think we see cuts this year at all. In fact, if anything, I think in my view, the risk would be for another uptick. I've seen a lot of studies that suggest when inflation hits nominally 6 or 6.5% and comes off in, like, I don't remember don't quote me on it, 9 times out of 10 or some crazy amount of historical significance, we do see another flare up before the inflationary cycle turns off. So now we've gone a couple of months where the month on month doesn't look like we're kind of like in that downward trajectory per se. And it was interesting when he told Nick to check himself about making assumptions about kind of discounting data he doesn't like. But it's really, for me, that was a very well poised question in that, we're not just on this steady glide path where inflation is seen going right down to 2%. You have employment really strong. You have the markets really strong. Where's this necessity for 3 or 2 cuts?
Yeah, and I think you're exactly right. There is a disconnect, and it's interesting that you say, in your personal opinion, that the next move could be higher. That has not been a popular opinion, but it is an
Not at
opinion.
all.
But it is an opinion that's starting to gain strength again, as it was at the end of 2023. Here we go into 2024, and there are those risks. I agree.
Yeah. Yeah.
So
So the argument can be made from the larger picture, Blake, that they're trying to navigate this soft landing. The argument can be made that we need a hard landing, because we're not talking about just wanting disinflationary pressures. We want deflationary pressures at this point. The prices that have rose, yes, they're not rising anymore, but those higher prices are having an impact on consumers, on the economy. So like there's an argument that needs to be made that, hey, if higher rates is going to cause that market correction or that big downturn, maybe we need that to re-equalize and kind of get equilibrium again on some of this. So Just a different, obviously a little bit harder of a tact, of a stance on what monetary policy, what their take would be. But that's, in my opinion, like where we really need to be.
Well, I think it's an interesting opinion, and I don't disagree with you. Let me just put it that way. But I think the market at this point disagrees with you and me
Correct.
because the market continues to grind higher. So
Right.
I know there's some charts you want to look at. I know you want to focus on the dollar index, which I'm really excited to see your charts because it's been real sloppy over the last this week.
Sure.
It's been really sloppy. But you're also looking at oil and other things. But I want to ask you your opinion on this before we move into those charts. The S&P is sitting at all-time highs. There are laggards. You look at the Russell 2000s trying to pull its head out of the gutter today. You got some of these Mag 7 big name growth stocks that have been just powering the markets higher. You got AI, you name it. What
Absolutely.
do you see with the markets as we sit here at all-time highs? Do we go higher, or are we due for some sort of correction in the markets right now? And by the way, if you have charts that you want to show regarding the S&P, feel free. But what are your
Absolutely. Yeah.
thoughts here?
So there's two things going on with the dollar, I think. So the dollar maintaining its stance, which is something we were talking about earlier. It's just kind of odd that we're seeing markets continue to rip higher and the dollar just really holding its own. There's a couple of bets. A, that higher rates for longer, okay, maybe the dollar gets that bid also. But also, if inflation is going down the tack that we're going to get 2% and that, Powell's on point and they're going to engineer this soft landing, it's still going to be the best, player in the house. On the flip side of that, obviously monetary policy moving forward, even if we do get those interest rate cuts, no one's expecting, let me say this, relatively speaking, it's still going to be a decent trade. So where stocks are right now, I think the path of least resistance is still higher. From a technical standpoint, I'll show you some charts that do give us some red flags, that there's some technical levels, some slope considerations, some trend considerations that we need to pay attention to, rather close to where we are now. But the path of least resistance remains higher just because you have that Fed put, which is sort of like it's a global phenomenon right now. But I don't think it's going to be telegraphed. I do think when the unwind happens and when we do sort of max out and hit an extreme, I think it's going to be rather disorderly because we have a lot of people. I mean, if we just think about the last 5 years, a lot of people who are now in markets who've never really seen a bear market. They've never really seen large market corrections. We haven't had a decent market correction in a long time. I think that might catch a lot of people off guard because there is so much fresh interest coming into the markets right now. But where we stand right now, I think there's a little bit more room to go before you start to scream, hey, I want to really watch out here. And with this being an election year, historically speaking, you still have that wind behind your back too. So it's again, from my standpoint, I think we're overstretched on a lot of different, not only just the S&P and the indices, and a lot of different sectors are just really, really overstretched. Obviously, tech being one of those, but that's not a reason in and of itself to get bearish, right?
Yeah.
So that's kind of where I am on the markets.
Okay, well let me get your view on the dollar because the dollar's been kind of sloppy. I feel like it's torn between a few different forces. You got Europe, which continues to, excuse me, I'm thinking about Europe as the Eurozone and as a whole. It's underperforming the US economy. But we've got, rates moving higher, yields are moving higher, dollars should be going, but then stocks are moving higher. So people want to sell dollars to deploy it elsewhere. So the dollar's being kind of pulled in two directions. You focus a lot on the dollar index itself.
Yes.
Where do you think the dollar is going from here? Because I am a little of two minds at this point.
Right. So should I bring up some charts?
Let's please do.
Just bring up some interesting charts that we're looking at. So this is a DXY. So just a disclaimer for anyone who's watching, I take a multi-time frame analysis approach.
By the way, I don't see your charts just yet. So yeah, you got to share.
Now you do. There we go.
Yes, sir. I see it. Okay, there we go.
Okay, right.
There
on,
we go.
Right
good.
on.
We're good.
So the multi-time frame analysis approach, right? We go from weekly to daily, and then into the nitty gritty. This is kind of like whether you're heading east, north, west, or south, right? So we just came off of a massively important level, Blake, and that was 102.75 into 102.95. We were watching this since the 105 clip that we turned from. uptrend resistance. This original slope dates back to 2011, and every red line you see here is a parallel of that same gradient, which has defined every major turn pretty much in the DXY for like the last 5 years. So this, chart alone has been something that we've been tracking for quite some time. Just rebounded off of trend support. Where do we go from here? If we drill down a little bit deeper, and this is kind of my focus right now into the close of this month, here's where we were off of the February highs. Where we turned yesterday, for me, was actually very, very significant. Those dots you see there, that's the objective monthly open, 104.12. A lot of my analysis has to do with identifying these key lateral levels that converge on slope. So whether it's a high day close or a monthly open or yearly close. So we've tested that for 3 days now. And the rejection and the nature of the advance has me thinking you're still at risk near term for topside exhaustion. That said, above essentially like 103, I still think the trade remains constructive. Now, the fact that they're still leaving the cuts, we obviously, a lot of expectations heading into yesterday was that they're going to shave off, right? 1 or 2 cuts because the inflation hasn't, a little bit slowed. The disinflationary swing has sort of slowed, but we didn't really see that. They're still talking about 3 cuts. And here's DXY reversing right off support back into resistance. This thing is just, largely speaking, if we were to look at all the FX pairs, we haven't really done anything. If we take a longer term approach on all of these are all range bound trades still. Here's Euro consolidation just from the decline in July. Here's Sterling consolidation just from the decline off July. So all of these trades, despite all the changes in interest rate expectations and Fed policy and 6 cuts to 2 or 3, we really haven't gotten larger directional breaks yet, which is why I don't discount the dollar just yet. So for me, the initial focus right now is topside exhaustion. You would need to close northbound at 104.77 to mark the resumption of the uptrend. Until we do, we still need technical clarity on these range breaks, critical range breaks. Doesn't mean there's not room to play inside, but I don't think we can make any major assumptions on the trend breaks just yet.
Okay, so I mean, and we can wrap it up in a nutshell with the euro. I mean, as long as the euro is trading below 109 and change, maybe 110, the dollar still has some life here.
Yeah, absolutely. 109.42, oddly enough, where we closed on a close basis, that's the objective yearly high week close. That's been a barrier I've been watching for the last 3 weeks to see if we can manage a weekly close above that. We haven't. So that's still, lends support possibly for the dollar still to kind of give its move. Aside of FX, I don't know if you want to go into any of the commodities. I mean, there's plenty of action there.
Yeah, I actually do. I know you focus specifically or have been on crude oil. I'd love to see crude because crude has been, you thought it's a breakout above 80. I mean, it's still today, it's still trading above 80 for WTI, but do we have more juice left in the tank, and what's that going to mean for the Fed?
Yeah. So I've long said that it is my opinion that the oil energy prices in general is going to be the sleeper cell for inflation. Even if we are getting the supply disruptions underhand, even if we are, getting demand pull at the end of the day, if we do see a surge in oil prices, that's going to upset the whole outlook for inflation moving forward. Now, given the macro geopolitical picture, and leaving politics aside, I've been watching crude with a constructive outlook since the start of the year. And that's not just because of the macro story, that's because of the technical story. 70.34 into 71.31 is what we talked about last year. It was the low week close for the year. It was a Fibonacci consideration. It was the 2022 lows. It was slope support. That's where we opened 2024. So on the way up into the open of the year, our constructive view was basically looking for 80.31, which was last year's objective yearly open, not Mike Boutros' opinion or Forex.com fact, and then keep resistance at 83.28, 84.57. We hit that yesterday. I actually put this on X in real time. So from here, I'm of the mindset that, hey, you give a little back, you take a little back. Here's what oil looks like on the daily chart. Even on a measured move off the low, that was exactly 2 equal legs. It's a nice place to take a little respite. I'm still constructive above 78.27, 200-day moving average, the objective monthly open. So maybe a little bit lower. But if this near-term uptrend is to remain viable, that's kind of where we need to find a low ahead of. On the northbound side, we've come into that big region. You'd need to close above 84.50 to really fuel the next breakout. And I think if we do get that, there's tons of room. That's going to be, in my opinion, sort of your breakout level. So maybe a little get back, looking for an exhaustion low over the next couple of days or weeks, but ultimately 84.50 is what needs to cap to really fuel the upside. And then the implications that could have for not only inflation picture, but downward down the line with the Fed interest rate outlook. I think that's where
Michael, I love your views here on the dollar index and crude oil. It looks like that you haven't given up on the dollar, and crude, you think it could pull back a little bit, but it's still grinding higher. As a trader, though, where do you think is the best opportunities to be? Whether it's FX, commodities, what are you looking at that's like, this is hot on my radar, it's sitting on my front burner, and this is what I'm looking to trade?
So I've been deep in commodities. Specifically since the beginning of the year, because of the broader technical view that they're opposing, the broader geopolitical environment that we're in. I just think that's sort of a natural bit. Now, as we move deeper into this year, I do think that you kind of want to ease that expectation. Gold, obviously, that's ripping to all-time highs. I think that's got a little bit of an exhaustion in it too, just over the next couple of days. But commodities have been huge. FX, I think you need to have exposure, because the winding of a lot of these trades are so pent up. I think once we do get these yearly range breaks in some of these trades, they're going to be runaways. You're not going to want to start chasing those. So I do think you should have some exposure in FX, heavy interest in commodities. The Bitcoin story also is something that's interesting to me that I have some allocation to, not actively trading it, but I do think in the backdrop of what's going on, having some exposure in that field is not a bad idea.
All right. Well, Michael, I appreciate you spending time with us here at the Traders Summit. I really do like your analysis, and I always have. But what are other, and I have to say this, I think Forex.com is blessed to have you as one of their senior technical analysts over there. So what's the best way for traders to follow your work specifically?
Well, the best way obviously is on X. At MB4X is where you can find me. You can find me also on TradingView. And also we do our Monday morning webinar every Monday at 8:30 Eastern on Forex.com. You can find the registration for that on X as well. And it's really the best place to kind of interact and throw around the trade ideas that we follow week in, week out.
Well, Michael, it has been a pleasure catching up with you, and it's been way too long.
Mine, sir.
I won't make that mistake again. I'll make sure I'll be reaching out to you more often to get your views, and hopefully we can get the dollar really turn in one direction or the other. And based on what you're saying, it looks like it might turn higher. So
we'll see. We need to get that breakout. Keep an eye on that yearly opening range. I think once it clears, we'll have directional guidance there for sure.
Good to see you. Thanks for joining us today, and I look forward to catching up with you soon.
Cheers, mate.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.